Good morning, everybody. Thank you for watching Taxes Made Easy. We've got a little bit of a different show today. We're not going to focus on the IRS so much as to how, again, I get questions, I didn't file my tax returns or I filed it. What do I do now? Do I just breathe easy? Do I just relax? And my answer to you is prepare. What can you do to make sure that you rock 2024? That you are ahead of your taxes, that you are ahead of your financial game, so that way when 2025 comes around and you have to file this next year of tax returns, you're sitting pretty. That's the goal. That should be the goal for everybody that ever has tax issues, or if you haven't had tax issues, how do you do better? How do you feel comfortable? How do you help run your business or your personal life better so that way you know you're fine? So that's going to be our topic today, and we'll be right back. Welcome back, everybody. Hubert Johnson here at Taxes Made Easy. Thank you for watching live or on rebroadcast. We've got an interesting show today, so I was putting this together, and excuse me, a similar theme kept coming up, and so this is going to be interesting. I'm going to be making some very conservative arguments from some very liberal sources. So again, it's just part of the problems that we face our economy, face our taxing system, is when we rely too much on tax the rich. And I don't fall in that category where I'm not making more than $400,000 a year. But again, what we should be focusing on what's best for our economy overall. So. And here's the problem: with inflation going through the roof, wages aren't keeping up with inflation. But one of the biggest problems is more and more people are getting pushed in that top category as, or being counted as the rich as inflation goes through the roof. So this first article, again, this is not new news, but again, buying a house hits a new record high, and prices have kind of tapered off, but the main thing is the median monthly house payment still goes up because interest rates, so that's an 11% increase from the same time last year. That is huge. 11% inflation just on how much someone actually has to pay for a home, which is just the actual cost. Now, what is being built into it? Under building, because of the cost of materials, cost of labor, people don't want to sell, increasing mortgage rates here, and then again, the mortgage rates are still increasing even though the Fed rates haven't increased due to inflation. They're seeing the cost of everything go up, and so it's a high risk market. So again, it's a problem thing affecting any new home buyers in the market in general. So, again, if you are talking to a realtor, you know a realtor, help them out. Check on how they're doing because they're struggling. And again, the fact that housing is more expensive than ever now doesn't help. It really is something that hurts a lot of people. So this is. I guess I'm doing two topics today, but this is a big article from the Los Angeles Times, and I think this hits a lot of really key things. And so I want to go ahead and share this article from the Los Angeles Times, and it's talking about California's budget. Now, this carries over to the U.S. budget as well. But the difference between state budgets and the federal budget is that state budgets are supposed to be balanced. They're not supposed to run huge deficits year after year, whereas the federal budget, they just go crazy. No such limits at the federal level. And so that's why we have an insane, massive debt, the biggest the world has ever seen. Now, so this is written by a columnist, but again, this is an interesting topic, and it talks about how many Democrats are seeing this problem. They're seeing the problem that's happening with the budget, and they've tried to do things about it. So we're going to talk about the overall economics here and how it hurts people. So the biggest problem here is when things are good, California does really well. And when it refers to Sacramento as the capital city of California. So every time it refers to Sacramento, it's like referring to DC. That's where the decisions are made. So an old saying is when the stock market sneezes, California state government catches pneumonia. So whenever there's a small hiccup in the stock market, it really hurts California. Why? Because they rely on the richest to pay. It's like 49.9% of the taxes. So when they make a lot of money off the stock market, Sacramento reaps a hefty chunk. They get a lot of income. Things do really well. They had 100 billion extra money in 2022, and what did they do with it? They spent it. So, and when I'm referring to the rich, it's the top 1% of California earners. So we're talking about the super wealthy, and they're paying half, 49.9% of the state personal income tax. That's not the whole budget, to be fair. But as far as income tax, who's paying their fair share, the top 1% are paying half. But then when stocks fell in 2020, so 21, huge year, 22, they fell down to just 38.7% of the total because they, again, the stock market got hurt. And then now they're facing a 40 billion deficit by the official numbers. And this columnist claims it could be a 73 billion. And that's to the LAO, the Legislative Analyst's Office. So the LAO is like, on the federal level, they have I believe it's the CBO, the Congressional Budget Office, where they're supposed to be nonpartisan, and they look at the numbers and they come out with their own numbers as to what they think things are actually going to cost. The politicians have their own spin, and this is typical. But again, it could be as big of a $73 billion hole. So we went from having a $100 billion surplus to down to a $73 billion hole. So you have a $292 billion state spending plan with the $73 billion hole in it. That's about a quarter of the whole thing. So if you're running a budget, you're running a state, and then all of a sudden you have this huge hole. You're bringing in a quarter less than expected, or 25% less than expected. That is hard. Imagine doing your own budget at home. You have your income, and all of a sudden your income drops by 25%. You're going to have to cut a lot of things. That's going to be really hard to make that budget. So it tries to sum it up, and here's kind of the heart of the whole article. Yes, there's overspending, but he says it's not because of the underspending, it's because there's an unstable state tax system that relies too much on the rich. Everybody loves tax the rich, tax the rich. But he said it's irresponsible and it creates problems and chaos when, again, what are the richest doing? Because they have assets, because they have mobility, a lot of them are fleeing the state. Silicon Valley is hemorrhaging jobs, it's hemorrhaging employees and large companies because of the taxes in Sacramento, on California in general. And this article doesn't even touch on that. So they put all these programs in, and 2 years ago they had a $100 billion budget surplus. Now it's flipped on its head. Now it's a $73 billion loss. So, they complain that, look, we have a lot of programs to help foster kids, help with green industries, transition people to green industries. and to help people in general. But now they're going back, and their concern is that instead of actually making real cuts, because nobody likes the cuts. Um, so the gist of this article is, look, we need to change things, get away from this, and they wanted to, one of the biggest things is to spread out the tax base. So instead of just taxing the rich, tax them, but not as heavily, spread things out. And so one of the biggest arguments that they made was they don't tax services in California. So the service industry, so again, the legal field, we don't pass on taxes. So usually when you go in, you get a massage, you go to a dentist, you go to a doctor, someone that's doing something for you. If they sell you something, then they have to pay taxes on what they sell you, an actual item. But if they're just providing a service to you and helping you out, financial advising, tax preparation, none of that is taxed in many states. So I wasn't sure about that, so I pulled up a quick chart. Service taxability by state. And it's interesting, in most of the western states have very little tax. So let me go ahead and share this. This didn't come over. Here we go. So it talks about analysis, different ways, services, business services, personal services. But this really sums it up. If you look at different services to real property, business services, personal services, professional services, and amusement and recreation. So I'm in Arizona, and the only thing they tax is amusement and recreation. So if you go to a theme park or anything like that, you get taxed. Same thing with Utah. They don't tax any of these in Colorado, California, none. But if you look at, especially most of the East and a lot of the Midwest, they tax these things. Mexico taxes them all. South Dakota, ironically, wouldn't expect it, but they tax all of those. So one of their suggestions is to spread out their tax base, which I think is wise to spread things out. We don't normally pay taxes, and I'm not thrilled about the idea of us having to have to collect and pay sales tax, but if it makes more sense. So going with this whole idea of how much, I think one of the most important things is to be informed about the history of things. And we've got 30 seconds before our next break. But I want to kind of touch on the history of how much have the rich paid in taxes. And so we're going to dive into that when we come back, and then hit the main topic for the day. But we're gonna be right back, and thank you for watching. Welcome back, everybody. Thank you for watching Taxes Made Easy on the Smart Money channel, or culture.tv, smartmoneyculture.tv. So we're about to jump into talking about the history of income taxes, which don't roll your eyes and just go to sleep. It's not. I think it's a little more interesting. I've alluded to it. I haven't really shared some of this information. So this is a nice, handy little chart here from the Tax Foundation, and again, there's some very handy information going through your account, breaks it down on a chart, but I think this chart really lays it out as to who pays the most taxes. So this breaks it down by share of AGI, adjusted gross income. So if you look at the top 1%, has 26% of the whole income. You can say, hey, that's way too high. Top 21% has 20% and 6% of the income. But federally, they're paying 45.8% of the total taxes. So you could argue, look, they're available to pay this. They have the funds to pay this. But again, you run into the same issue where you rely too much on the top 1%, and they are mobile. They can move, they can adjust, they can hire, and again, the audit rate is, I think, around 11% for the top 1%. So the top billionaires, they get audited every single year. It's just par for the course. They understand it. It's just whatever. They're ready for it. So saying they're going to increase audits on them doesn't mean much to them. They're already taking advantage of as many loopholes because they know the IRS is going to scrutinize them, and I mean it's going to be a pain every year anyway. So that's why they just put in the hands of CPAs and attorneys, and it is what it is. But how many people make up? Again, it's a small number that makes this group up. And talking about California, the number was about 1,000 people in that top 1%. So it's a much smaller number than you would think that's paying half or close to half of of state and now similarly federal taxes. So when you look at the top 5 to 1%, they're paying a little bit more, 19.9%. And then your middle class, is getting a little bit of a break here. The 10 to 5%. These are mostly your business owners here in this area. And then you jump down to 25 to 10%. That's your middle class. And so they're getting a break there. So between 50 to 25, there, when you're in the lower 25%, well, from 50 to 25%, they're paying about 8.4% of the taxes. And the thing is, that's really around 100,000. Once you go over 100,000, I think it's 91,000 in adjusted gross income, then your tax rate just goes from 12% to 22%. So it's a big jump, and people really try to stay on that 12% side as much as possible. Once it goes over there, then over that number. And then the bottom 50% have 10% of the adjusted gross income, but 2% of the tax base. Now, many people would argue that 1% having 26% of the adjusted gross income is unfair, etc. And I'm not arguing that at all. I'm just saying, look, it's important to be aware of what this actually looks like. So I'm going to jump to the next tab, and this is from Wolters Kluwer, a tax accounting and finance firm, talking about historical tax rates. So when the taxes first started in the Civil War, it was just a flat tax until about 72. Once the war had been wrapped up and the costs of the war were winding down, it was repealed. It was just done for the Civil War. And then in 1913, this is when they came in and said, look, it's only going to be 1% tax. Just a 1% tax. But then they added a 6% surtax on it, so 7%, right? And then with a few years, it doubled. And then 1917, then again, we were in World War I, it shot up to 67%. So this is the top 1%, is paying 67%. So every $3, $2 went to the federal government. And then it went to 73% in the 20s, and then in the Depression, it actually went down. Well, leading into the Depression, 22, 24, and I believe it was. This is really when you had the New Deal and Franklin Roosevelt take over and come in. This is when, again, the top 1%, again, we're getting taxed throughout the New Deal era, 63, 63, 79, 81. And then you hit World War II, and it jumps up to 94% by 1994 or 1944. So a lot of people argue is that through this New Deal era, with Roosevelt, they argue that the fiscal policies here, through 32, through our entrance into World War II, is what really hurt the economy. That the government started spending money like crazy and all these programs, and part of it is people wanted to see the government do something. So Franklin Delano Roosevelt looked like he was doing something. The government was doing something. They had programs. They put people to work digging ditches and then just filling the ditches, doing something so they could give them some money, etc. But by taxing the rich, by all these social programs and just overspending, there's a lot of arguments out there that they extended the Depression, which should have been a year or two of pain and then, okay, things returned to normal, which was typical, that they extended out the Depression for years. From really, things were bad through the 20s. You had the stock market crash, but things seemed like they were recovering. Well, they didn't recover right away. Then Franklin Roosevelt came in with his New Deal, and then it was another 8 years until World War I that really pulled us out of the Depression. And through, again, here you have the interwar year, or during the war years, really, really high interest rates. And even after the war, it stayed at 91% until 1963. And what happened in 63? Kennedy came into office. And then LBJ. And so they actually started, well, it was 77%, and then through 70%, 65 through 81. So through LBJ, Vietnam, Carter, Nixon, and then Ford, and then Carter, and stayed pretty high at 70%. And then you see this huge drop down to 50%. What happened there? We had a new election, a new president. And what happened to the economy during this period? It dropped the rate from 70% down to 50%, and then in 87 down to 38.5%. So this is the last Reagan tax cut, was 38.5%. And ever since then, it's hung around that area, around 38.5%. When you add on state and local fees, the rich typically still pay half of their income and fees. But during this time period where you had 80, 90%, 70%, it doesn't make a lot of sense to have income. So what do the rich do? They use loopholes. They went around the system. They were creative to avoid paying, $9 out of 10 you're going to pay to the federal government. What's the point? So they use the system. They went around the system. They used loopholes, foreign tax shelters, etc., to get around the system. And again, tax revenues showed that. So, but when they dropped the tax rate, all of a sudden people brought money back in. They were playing within the system, and a lot of loopholes were closed. And then moving forward, that's why they said, okay, we're going to close taxes. They dropped down to around 31% for just a little bit. And then Bill Clinton was elected, back up to 39.6%. And that's kind of typically what we've seen is between 39 and 37 under Trump, but not too much variation in the last really 40 years. They've kept it around similar numbers. So I think it's interesting to note when we say tax the rich, they're paying that. They're paying that full amount. I've got one last article I'm going to share, and this is from Market Watch. And so going through the stats, they've recovered $500 million, but with increased income, audits on, super wealthy. But then, of course, it doesn't just hit the wealthy. So again, a lot of information about, okay, we went after the wealthy, This is what I want to focus on. So they're saying a lot of these audits going after the earned income credit have gone up, and they disproportionately affect poor and minority homes. Or they say there's a lower audit rate, but it still hurts people. In my practice, what I've seen is that you have more audits. Maybe not on the poorest, but on a lot of business owners, people in that middle class, there's been an increase in audits, and there's been an increase in audits where they sit there and they look at every single line of the tax return to scrutinize it. So again, when they come out and they say, look, we're just going to target the rich, don't buy it for 2 seconds. Again, they go after all taxpayers, and again, we're all in the same boat together in the American economy. You might not feel like it, but this idea that we can hurt somebody else without hurting the overall economy, it's just not wise planning. It's not wise tax planning. And we see this in California, we see this in elsewhere. Again, when Trump did his massive tax cut, it was all in the news about how they even gave him a break. Hey, bring your money back, repatriate your money, bring it from overseas to the United States, invest in our economy, and we'll give you a break when you do that. And you know what? Billions of dollars came to the United States. Billions were invested. It's one of the reasons things boomed. Right now, with all the tax, again, the inflation rate is out of control here. Not out of control, but it's definitely higher than expected. A lot of money has gone overseas again. So again, we're not dealing with the 70% rate there in the 70s. But again, it wasn't just Carter's fault that tax rates were that high, because they had been that high. But when you drop them down to around 40%, just under 40% from 70%, that's a huge change. And it made a huge difference in the economy. And overall tax income and receipts went up. So again, we're collecting more money than ever now in the federal government. But the question is, what are we doing with it? I'll tell you, the first thing we're not doing with it is planning. Wise planning. And so that's what I really want to focus on the rest of the session today. How do we make wise planning? Unlike California, unlike our federal governments, we can't run deficits like that. You can. And it only hurts you to run deficit spending and ran up more and more credit cards. Because the only option really is either let them default, let it ruin your credit, or file for bankruptcy. Neither of those are great options. So first thing I want to talk about, if you're going into 2024, right now we're just past tax season, and I'm getting the question, okay, what do I do now? Or can I breathe easy? First thing is, if you haven't filed 23, get it filed. Don't wait for October 15th, because this is what I see too many times. People finally, tax day passed, they can breathe easy, or they think, okay, I filed my extension, I don't have to worry about it until October. And because they don't worry about it until October, they don't know how much they owe. They don't know how much they're supposed to pay in estimated tax payments. They don't know what their business is doing, because they're filing their tax return 10 months after the tax year ended. 10 and a half months if you go all the way to October 15th. So by the time those numbers finally get filed and processed, they're not very useful in you as a business owner or running your household, because they're so old. Things change, costs go up. So there's plenty of businesses where, look, they have to wait for K-1s, they have to wait for other information, they have a lot of work to be done. So yeah, it's going to take time to get all of that information. And for most large businesses, it's just a matter of course, just October 15th, that's what they're going to do. Or September 15th for the business returns, October 15th for their personal returns, because they have to wait for the business returns to be filed first. And that's just the way it is. But you can, especially as a individual or a small business, you can and should do better. And this is the advice that we give out, because we don't want people to owe taxes. We don't want people to become repeat clients. And we joke around that if we do our job right, and we're kind of joking around about this, kind of serious, but if we do our job right, we shouldn't get repeat business. I hope I don't. Because if you come back, you've messed it up. You've owed again, and sometimes life happens where you owe again. Okay, great, come on back, we'll help you out. Someone gets sick, stuff that you can't foresee or prepare for. But that's the idea, that if you are prepared, you never need to go and pay some tax attorney to fix your case again. And again, you have to go through all the stress, the headache. My goal is that people learn and can move forward with their lives. That's the ideal. That should be the ideal, rather than dealing with the headache. And, again, I've got this tax issue, we got past tax day, I'm just going to bury it till next year and not worry about it at all. Not a wise move. So first of all, get your 23 return filed, work on it, have your CPAs work on it. If you're waiting for information from other businesses, K1s, etc., okay, but there are things that you can do. Number two thing, number one is file your 23 returns. Move forward, make sure that it gets done. Just don't put it on the back burner for 3-4 months, because you're going to be right up against another rush and filing things at the last moment again, and that's what a lot of people do. It's procrastinating is easier than jumping on it. But if you get in the habit of jumping on it, not only do you have time to fix issues and look at it, make sure it's done correctly, but you can breathe easy once it's done. How do you get your books together? So I'm not telling people to go and become a bookkeeper. You shouldn't. If that's not what your expertise is in, if that's what you know, that's not what you know, then you shouldn't be doing that. I've had plenty of cases where people go and their wives help them do the bookkeeping, or someone else, they try to do it their own, and they didn't know what they were doing. If you have that background, you have the time to do it, great. But one of the smartest moves I see people do is when they understand the limits of their own expertise. I don't do my own plumbing. I've tried before and made a bigger problem and had to call a plumber. I do minor repairs on my cars, but anything major, we had a transmission go out. I took it to a transmission guy. Just understand the limits of your expertise and get help where it makes sense, especially for small businesses. There's too much at risk here, and it can really hurt you when you don't have the right information and it's not done correctly. So we're coming up on another break in just a few seconds here. We're going to continue this conversation through, and we'll be right back. Hubert Johnson here with Taxes Made Easy. Thank you again for watching. Why do we want to get our books together? And a lot of people, you'd be blown away by how many self-employed individuals have no idea what they're making or earning from their business. Why? It's because they don't have a good handle on their books. They don't know what their monthly expenses are, and they just know they're surviving and making money. But what happens when you do get a handle on your bookkeeping? So first of all, getting a good bookkeeper, you can use, in my business, we have a bookkeeper that assists us, but my office manager, through professional advice, has put together, and she uses Quicken. Whenever she has questions, she always has someone to turn to, and there's plenty of other budgeting programs that will help not only as individuals, but for businesses. Manage all of your expenses. They'll pull it straight from your business account. So as long as you are running your bank accounts correctly, it not only is easier for the IRS to see what's going on, but it's easier for you to see what's going on too. So again, this gets back to a very basic thing. If you have a business, if you have a side project and you don't have a separate business account for it, go get one. And number two, treat it like a business account, which means only business expenses, only business income goes in there. So all the net revenue from your business goes into that account and that account only, and only business expenses are run from there. And when at maybe monthly, however frequently you want to pay yourself, you can either do owner draws or you can set it up where you get paid as a W-2 individual, but you've got to track that. good numbers will absolutely help you prepare for the future. So, again, I didn't even throw that in there at first, is to make sure you have a business account and that you're running it correctly. If you're W-2, make sure that you are tracking any kind of deductible expenses, charitable giving, and we're going to get more to that. But having a budget program. If you're not self-employed, one of the most common ones out there is Dave Ramsey has Every Dollar. There's plenty of other programs out there to help you and your family keep track of your budget. Takes a little bit of effort, but again, if you pay a little extra, it'll pull the information directly from your checking account. But again, it's not going to track any cash transactions, but it can put together your budget for you fairly easily and efficiently, and then help make recommendations and help you prepare for what's happening. So one of the biggest changes this year, and this is one of the whys. So again, I want to touch on before I jump into that. How do you find a good bookkeeper? So just last week, we referred someone to a bookkeeper in San Bernardino, California. We're in Tucson, Arizona. But there are networking sources. There are ways to reach out. Go to your CPA. Go to someone that's a financial professional and ask them for a recommendation. If they don't know someone, you can always call us and we'll give you a recommendation. We'll refer you to a couple people. We always try to send out a couple referrals so you can choose, or you can check out some of the online options and try it out, see what works for you. And if it doesn't work for you, just try something else. First issue of why we're going to do this: estimated tax payments and making sure you have sufficient withholdings. So if you didn't owe at the end of the year, great. But if there's any significant changes in your income, usually the last thing people think about are taxes. So if you take money out of a 401k, if you get a bonus, any kind of things like that, most people say woohoo and they go and they spend it. Stop, look at your budget, look at what it's going to do to your year-end taxes, and set aside a chunk in savings. So we should all be building a savings. It's something Americans are horrible at as a country, is saving money and preparing for rainy day funds. So the estimated tax payments, the first tax payment was already due April 15th. So if you missed that, prepare for the next quarter, which is June 15th, only 2 months away. If you typically owe taxes, or you have a side business, or you have any other source of income that's not taxed directly by an employer, you should be setting aside and making regular estimated tax payments throughout the year, because it's actually legally mandated that you pay your taxes throughout the tax year. And they just, I mentioned plenty of times on this show that they increased the penalty from around 0.5%. Congress did this last November in 23 to 8% penalty. Pardon me, for not withholding enough taxes. So that should be enough of a wake-up call. You're paying 8% throughout the year if you don't pay in taxes throughout the year. So June 15th, next deadline, put that on your calendars. And after that, it's 4 months till September 15th, and then January 15th after that. So it falls on the 15th or the next business day, if the 15th falls on a holiday. So make sure you're on top of your estimated tax payments. And to do that, you have to have an idea of what your income is. So if you don't have a clue what your income is until your taxes are done, your business taxes and your personal taxes are done until October 15th, how in the world are you supposed to do this? Well, you can estimate off the previous year's return, 90% of the previous year's return. If you're assuming your taxes are at least 90% of the previous year, or if you have if you have regular budgets, you should be doing a profit and loss throughout the year. You shouldn't be taking a huge stack of receipts to your CPA or bookkeeper, and they will love you for it. If you do the planning throughout the year, not only does it help you with your monthly budgeting that you should be doing, but it can also help you already start that work, start the bookkeeping, so that way every quarter at least you should be looking at your numbers. How do we do? Where are we losing money? Where are we? Where? What's working for us? What's not? And you should be able to make wise business decisions or informed business decisions from there. I don't know how you run a business if you don't have good numbers. People do it all the time, but a lot of it they're just flying in the dark. So especially smaller businesses, larger businesses, they do all this. They do all these numbers. They do all the number crunching. They have teams of accountants and bookkeepers. And so even though they're a much larger business, they do this. So when a lot of medium-sized businesses, they don't have this all together. I've seen businesses that do millions of dollars of business, and they had one person that did their bookkeeping and they used a CPA, but they weren't on top of it where they were doing this regularly. So again, it's very, very typical to be rushing at the extension deadlines. Part of what the IRS is doing is with these ETPs here, they're forcing people to look forward and to be better prepared on their tax returns. Well, they're not forcing you, they're just going to charge you more money if you don't. So this is why not only will it help you run your business, it'll help you understand what's going on, but tax planning is huge, and it helps you understand what you're looking at. So I sat down with my CPA before this tax year, and I looked at what I was expecting to owe, if anything, and I said, look, I can pay a little less in taxes because I think I'm going to be spot on. I could do a little bit more of charitable giving. I know here in Arizona, there's a tax credit. So whatever we give to the schools or to different charities, as long as it qualifies, that's taxes I'm not giving to the state of Arizona, but I'm helping out a charity, and it's dollar for dollar. So it doesn't cost me a penny to help out a local charity or school instead. So you can look at charitable giving, wealth building, planning. So you should be planning, for business to be paying down debt, especially with interest rates, credit card rates the way they are. You should be getting rid of debt and then saving money. And then part of wealth building, the biggest part of wealth building is retirement planning and savings. So there are tax advantages to engaging in retirement planning. And so all these options open up. Imagine the peace of mind if you know you have money set aside in a rainy day fund. You have money set aside for your taxes. And now you're investing for your future and your retirement for you and your employees if you're a business owner. That's where we should be, and more, that's where Americans are getting away from. Number one reason that's causing people to hurt financially, inflation. Wages are not keeping up with inflation. We talked about the cost of housing going up 11% from last year. That is the real inflation. That's really what's been hitting people. And so that becomes more and more important to have your financial house in order and to help us weather these times. So again, when you have this idea of getting professionals to help you, ironically, services like that are the number one things people tend to cut. I mean, it's easy to back off and say, okay, I can't afford going to the chiropractor. Health and services are what people pull back from. But ironically, that's especially the financial services. That's what's going to help us get through these tougher times. So that way we can be comfortable and in a really good position to take advantage of when the economy turns around. When that's going to happen, I don't know. I have a bunch of people, a lot of clients that are kicking the can down the road, trying to avoid taxes. Again, we talked about 21, tax went up, 22, 23, the stock market crashed. And people rode that roller coaster and lost millions. But they're getting taxed along the way. And so they're trying to deal with these huge tax burdens from 22. And they're just trying to kick the can around until the economy recovers. If you're well prepared, if you're diversified, if you have plan A, B, and C in place, you don't have to worry about the highs and lows of the economy or what the government is doing because you already be prepared And when they make changes, when there are opportunities, you can take advantage of it. There's a lot of money sitting on the sideline right now, especially when it comes to the rental market or the mortgage industry, because it's too expensive. When 2011 came around, my wife and I were lucky to purchase a home. It was almost a 3,000 square foot home, very nice home, and we got it for $235,000. That home today is worth a lot more, I'm sure. Just to give you an idea of how things have changed. $635,000. Same home, and it's just, yeah, just a few years, massive change. And so getting in, buying a home, making good investments for yourself, planning for the future is how you not only avoid tax issues, but help your family thrive through difficult times and get prepared. So when the next, drop in the economy happens, and it will happen, you'll be prepared and you can help your children out rather than scraping by. You can be thriving and living an abundant life rather than scraping by. And really this idea that I took from a business coach, one of our business coaches that have helped us, this idea of living abundantly is all about being prepared. And that way, when tough times come, you're prepared for it. When things are good, you can take advantage of the good times. And again, this really is what helps people breathe easy and find peace of mind. And that's really what our goal is long term, is help people to do exactly that. So again, if you have any questions, if you think you could use the help of a financial advisor, there's even financial coaches that will help coach you personally. Many of them are trained by national figures such as Dave Ramsey or other professional advisors, and they can help you improve your budget for yourself personally or for your business. They can guide you through this process, and again, having a bookkeeper that works with you throughout the year, and you can sit down, or CPA, you can sit down and talk about tax planning and strategies to help you in your business, personally or for your business. A financial advisor can be very key to long-term health, and those are the kind of people that we should be talking to. If nothing else, just to give some information and sitting down and interviewing with some, you'll probably learn a lot just sitting down and talking to them. And those are the kinds of people we should be rubbing elbows with to help ourselves and our families long term. So again, I hope you found this helpful. But again, a lot of people, right now is not the time to just sit back, breathe, and relax. It's a time to prepare. So that way, in the future, when you have everything rolling, everything already set up, you can focus on what makes you happy, and either maybe it's focusing more on your business, or focusing on your family, or going and taking a vacation. Imagine that. So again, thank you for watching. Taxes Made Easy here. Give us a call if you have any questions, 520-485-7371, or you can reach out to us at info@guardiantaxlaw.com, or go to our website, or look us up on YouTube, Facebook, Instagram, guardiantaxlaw.com. And that kind of wraps it up for today's show. Just really want to show that light at the end of the tunnel today, that there is financial freedom available out there. We just have to prepare, plan for it, and do better moving forward. And it's all step by step, and we can all get there. Again, have a happy Monday today, and we will see everybody tomorrow.